So you wanted us to? Did you want us to do anything else?
In terms of
We can now continue to how now the forex rates now the bank or reserve bank of a country can come in terms of forex risk management. So the central bank or reserve bank of a country will now come into forcing the capital adequacy requirements and also ratios. For example, the LCR, the liquidity coverage ratio, or the NSFR, the net stable funding ratio, and also even the CET. I mean, we know what the Basel 3, for example, framework demands or requires. For example, at least 4.5% of the net assets should be in CET1, in common equity of the, but those net assets has to be obviously the reserve bank of a country or a commercial or even the commercial bank or even the central bank of any country now can come in and enforce these capital adequacy ratios, especially after now enforcing the bank to do their risk mitigation, also risk measuring and monitoring frameworks to enforce the risk mitigation and basically to maintain their capital adequacy. Because as we saw, the risk profile of the bank or for example the forex risk now and currency risk that they will have suffered or they will be exposed to will have a say or will influence their ALM strategy, asset liability management and mix. Okay, and that basically now will lead to capital adequacy concerns. So now the central or reserve banks will need to enforce that such banks are able to monitor their ALM strategies as far as forex risk is concerned. But then how do they do that? Then they must ensure that the commercial banks regularly monitor their forex risks and also do, for example, periodic disclosures. So reporting and transparency generally. So the banks need to be, for example, disclose, for example, annual or monthly or even daily reports on their forex risk exposures and also measures they have taken into, even for example, if the forex risk led to a negative NII, what measures have they put in place to hedge themselves against such risk? Yeah. And such measures can, as we saw, they can use the hedging strategies, the derivatives, the option swaps, futures and forwards, and also even diversification of their stable funding sources, and also even diversification of the currencies that they invest in. Yeah. As we saw, they should not just invest in any one currency just to hedge themselves against such or mitigate such forex risk and currency risks. But also, in the process of even enforcing such rules, the central bank or reserve banks of the country will also need to make sure and enforce regulations that the banks should also even comply with not only just the liquidity management frameworks, but also even the normal frameworks, for example, AML, and that's why it was coming in, and even they know your customer the KYC regulations. For example, if if you don't regularize your traders, for example, even you don't regularize, there is no proper KYC and AML regulations of, for example, even bureau de changes, forex bureaus, yani, or banks forex bureau or treasury departments, then there can be no proper AML and KYC. So that will in turn increase their bank's exposure towards forex risk. Okay. So the CBK or the Central Bank of Kenya or the RBM, in this case the Reserve Bank of Malawi, will need to make sure that the commercial banks adhere to the rules that govern, for example, the foreign exchange trading, for forex trading, to ensure that such banks they can prevent, for example, anti-money laundering and also uh, breach of KYC regulations, which can even in turn lead to further forex risk. So, in conclusion, we have seen how managing hedging strategies reserve or commercial banks or the central bank to be able to hedge their treasury departments and banks, uh, to be able to hedge themselves against forex and currency risk. And that all basically involves just speculating for the profit and positioning yourself, for example, against a currency devaluation or a currency strengthening, and therefore you are able to mitigate risks that are associated with that currency fluctuating either favorably or unfavorably. So if should it uh, fluctuate favorably, then you take a long position, shield it, and then you take a short, shield it. Otherwise, you take a short position to be able to make profits and even be profitable, and also even maintain your liquidity, maintain your ALM mix and management, and also even at the same time maintain enough capital buffers to be able to handle such foreign exchange sudden and unfavorable fluctuations and risks, to be able to handle losses that arise from forex risk, and also even short-term obligations. Let's say you're a bank, you're a commercial bank, you borrowed in the interbank market, and then or you need to as a borrow. Let's say your customers lent you 10,000 USD, and then you need to pay that 10,000 USD. Let's say it's a short term term deposit, okay? And then so now, if you don't do proper liquidity management of your forex reserves, if you don't have enough forex reserves to be able to handle such a surge in, for example, forex withdrawals, then you will be not in not compliant with the CBK, Basel III, and also liquidity management ratios and regulations. So effective management will ensure that effective risk and compliance management by the bank's treasury department will ensure not only that you comply with your short-term financial, for example, also withdrawal obligations, but at the same time you maintain profitability and comply with the Reserve Bank and CBK regulations relating to forex and also liquidity management.